Hi. With 24 years of investment experience, I want to introduce Sonia Kowal to you. She's a president of Zevin Asset Management, which is a long-only global equity active manager. Zevin combines fundamental research, macro considerations, and ESG analysis to identify risks and opportunities. Also, they're involved with shareholder advocacy initiatives that create positive social impact, and we'll be talking to Sonia about that today. Previously, she was a senior research analyst and head of ethical investment research services U.S. Boston office, and she was a PM and investment research analyst in EM at Baillie Gifford in Scotland. She holds a BS from the University of Edinburgh and an MS in investment analysis from the University of Stirling. Zevin was a best in the world B Corp for the last 6 years, scoring in the top 10% of all certified C Corps for their focus on serving clients as they solve very pressing social and environmental issues. Zevin is part of the certified real impact tracker community with a near perfect score. And they've been named the PSN Top Guns list as well in their past. So welcome, Sonia. Thank you so much for joining us today.
Thank you, Nadine.
You must be having a field day if you're looking at financials right now. So, before we get into investment ideas or your thoughts on that, let's first step back and talk about your investment philosophy. I know overall the firm's looking for consistency in revenues and earnings, as well as other quality, what I would call quality metrics like solid ROEs, ROICs, and of course, reasonable valuations. We always hope for those. But maybe we can talk about whether it's the social or other metrics. What makes a target investment for you?
Yeah, I mean, the quality aspect of what we invest in is definitely front and center of our process. Philosophically, we're very patient. We're prudent capital allocators. We don't feel that pressure to create portfolio turnover just for the sake of showing activity. We're pretty style disciplined. We have a strong sense what we're good at. We stick to that playbook. So that includes finding those highest quality businesses to invest in, paying close attention to a variety of risks, adhering to that consistent valuation framework, and then allowing those learnings from our ESG analysis and company engagements to inform our decision making.
And when you look at that, the ESG piece, right? Are you using your own data? Are you using outside sources? Or how are you evaluating ESG considerations?
Yeah, that's the really tricky thing, right? So we're not...
That's the question, yeah.
Yeah, so we don't do this via data mining through the ESG research providers. We do subscribe to them, but they're just one small input. And it's a red herring. I used to work for one of these research providers.
That's what I'm asking. Like, what are you doing here? Because I've looked at the data, right? And I also try to say, it's, they're different versus the providers. Does it really cover the whole world?
Yeah. I mean, that's what the sell side is all about, right? That's what makes a market. But it's the information in these data providers is very backward facing. Yeah. It only gives a very superficial view of what's happening within a company. And so it's useful for a quick check, but to base an investment decision on that is a terrible idea. And so instead of relying on external research, we're conducting primary research, right? On various issues and locations built up from decades of experience in the field, listening to advocacy organizations and stakeholders on the ground. So that's how we build up the ESG kind of, our ESG view of a company. And ES and G is so separate. People like to put them together, but they're totally different.
And so is it the same team who's looking at all of the different metrics, or do you have experts or people looking at particular things? How does your team work?
So we have fundamental research analysts, equity analysts that are really looking at the financials of the underlying holdings. And then we have people that are more concentrated on the ESG side of things, but they work very closely together to identify ideas, to go through risks, that sort of thing.
And are you looking for, call it an absolute score, so you're looking for a certain type of quality? Or are you okay with companies who are improving? So when you're thinking about ESG metrics, are there hard and fast rules, or are you looking for acceleration, deceleration of certain types of metrics? Maybe talk to everybody a little bit about how you think about the things that you're looking at.
Yeah, we actually don't look at metrics very much. We don't
Okay.
think that these issues are easy enough to distill down into numbers. And so we're looking at more the qualitative side of things. Obviously, something like environmental issues, sometimes a company will report enough data to analyze quantitatively their performance, but that's
Mhm.
pretty
Yeah.
unique. And you can't really do it comprehensively across the board and compare and contrast companies that way. It's not like doing the same thing with a company's financials.
And so how does one know if, so are you doing it because it's the right thing to do, or can you show alpha from this type of work? Because I think that's a lot of managers struggle, right?
Yeah.
Is that what to do here, and what, is it depend per manager? Do your investors care just overall, or are they looking for you to prove that it's doing something beneficial to the portfolio outside of, call it a values-based approach?
Yeah, so it's interesting. We tried to work with Bloomberg a few years back to try and pull out the alpha from our kind of ESG, or from the work we were doing on ESG. And especially in a global portfolio, it's really hard to do that. There's just not enough coverage, and the data is really not good enough. And so
I
we
found the
have,
same thing, by the way, Sonia. I
yeah,
worked with them too, and I was like, how can I ever talk to people about this if I can't show the alpha and show that's why for me, like, metrics have to matter at some point to show alpha.
yes.
Otherwise, you can't quantitatively show anything.
Yeah, and so it's kind of, we have not been able to prove that. We think that we have added alpha through ESG analysis, and we have kind of various stocks that we either stayed away from or we've sold because we've noticed deteriorations, but we can't prove that comprehensively through, looking at kind of a big picture in numbers. And so I'm always really interested to hear about others that have.
Yeah.
I mean, you have all this meta-analysis, from all these different academic studies, which seems to be pretty, it seems to show that, you can look at ESG and outperform over time. I don't know how much causality there is there, because it really depends how good you are at analyzing these factors.
Right. Especially since last year, if part of your ESG had, a belief about certain things in energy, we have clients who had boundaries around it. You couldn't invest in energy, and that was the one performing sector last year, right?
Yeah,
Internationally
but
on a developed basis. So
that's true, but careful stock picking in other sectors could
sure,
overcome that. And that's what
sure.
we found. We didn't own fossil fuel companies, but we did really well regardless of that,
And
because
so
we,
maybe give
we
an
did really well
example.
in
Like
other sectors.
we have a pensions that it's like basically no materials, no energy. So certainly there's some industrials, you can find sometimes in discretionary, but how do you deal with that when you saw such a macro move last year?
Yeah, I mean, it's tricky when you have a broad kind of blanket screen especially a few sectors. That makes it really tough. Luckily, we don't have that. I
Okay.
mean, fossil fuels is the one area where we're not comfortable investing because they don't meet our environmental criteria or our social criteria. And on governance, they're still being compensated for growing, right? And growth through exploration and production. And what we would like to see these companies do to really adapt to the future is shrink, throw off all that cash to investors and let investors do what they want with it. Because we don't think that they can really transition to be energy companies the way that they need to for the world to hit net zero.
And so you're looking more at infrastructure like utilities or other areas, or when you think about, investing in improving the future, what types of investments then are you looking for?
Yeah, so we just bought a building materials company, for example, that focuses on reducing the carbon of cement, for example, and other kind of um, materials that are used in renovating buildings to make them more energy efficient. So these, that's a pretty positive holding. Not all of our holdings are that kind of aligned with a net zero environment, but that's an example. Or we'll hold a renewable stock, or we'll hold, a utility that's forward thinking. But, we need to keep volatility at a minimum, and we need to focus on quality. And not all of these kind of energy transition companies have kind of met our quality criteria.
And so is minimum vol in the business or in the security, what you're looking for?
Typically in the portfolio, but we don't want too many of these small, super volatile companies in a portfolio.
And so maybe talk to people a little bit about portfolio construction. How many names do you typically have? Where are they placed around the world? Are they, large caps? How do the people think about the portfolio construction of what you're doing?
Yeah, so they are pretty large cap. We have a minimum large cap criteria of 10 to 20 billion, pretty concentrated, 30 to 50 names. We're benchmarked against the ACWI, and really the portfolio construction is all around managing risk. So looking at correlations around the portfolio into risk factors, managing position size and diversification, and then, looking at trying to reduce portfolio downside resulting from exposure to, different regions, countries, sectors, that sort of thing. And then really focusing on ESG in terms of trying to figure out who's going to face future liabilities from this. And then, on the stock level, focusing on avoiding potential significant losses of capital because of excess valuation or declining cash flows, that sort of thing. Minimizing exposure to excessive financial leverage. That's a really key one right now. Low returns on capital, and then, declining profit margins.
And so since you're playing against such a broad-based index, are you play across sectors, or are you more narrow because of the quality threshold that you want?
No, across sectors. We do take bets. Absolutely. We're not kind of closet indexers by any stretch. Historically, we've had a fairly large allocation to IT that's come in the last year. So we're fairly kind of market rate there. Severely underweight financials. We really don't like the banks. We never have. And that's holding us in really good stead right now.
And I was just looking at ours because we play against ACWI ex-US. And so we're underweight financials because we're overweight financial exchanges.
Okay. Yep.
Right. So yep. They sit in financials, but like they're up when the banks are down, right?
Right. So it's a nice hedge.
Yeah. So maybe talk a little bit about how do you incorporate the macro into your process? You mentioned a little bit about, historically maybe being overweight IT, but then you look at last year and obviously the play other than energy was knowing rates going up. What does that do to long duration? So how do you balance that from whether it's portfolio construction or just risk management to know what is correlated? Because people wouldn't have thought of that. Obviously, look at what's happening with the banks 5 years ago. But at the end of the day, a lot of positions ended up to be correlated with long duration.
Mm-hmm. Yeah, so we have somebody on staff who's an econometrician. And so he really has a job of being our macro analyst, right? So, and that helps inform our decision making and then provide insights for the PMs and the equity analysts on how different regions around the world are faring. So, we think if you're a global investor, it's really important to look at the macro factor. So what he does is run various global business cycle scenarios through a proprietary econometric model to help us identify different regions and sectors of opportunities and risks. So he, to be honest, I'm not really sure how he does that, but it's, he's been working on this since 2008 and has provided a lot of value.
So now looking ahead, it's interesting how a month ago, everyone was thinking that rates were going to, first rates were going up and then they were going down, then they were going up, and now they're, maybe a little bit up, and then, people lopped off maybe 100 bips on short-term rates in the last 24, 48 hours because of concerns of, credit liquidity. How do you guys think about the next, I know you're long-term, but let's say a year, and thinking about how rates affect your portfolio and inflation?
Yeah, so we've written about it a couple of times in the last year, and obviously it's important, but we're trying to not be so reactive to what's happening in markets right now. Obviously there's a lot of skeletons that are coming out of the closet, and you know, there's obviously certain sectors that are more exposed to an economic cycle, but we're really looking at fundamentals. And we understand that sometimes sentiment kind of gets in the way based on where a company's located or whatever. But we're trying to write out all these ups and downs and don't focus on them too much, even though we're watching interest rates and market sentiment like a hawk.
So rates wouldn't, for example, drive allocation or risk management in your portfolio.
No.
Okay. So looking ahead, when you think about defining risk, you might be defining it the same way you always have. Talk to maybe a little bit about how do you define risk, and then how do you incorporate risk management into what you do?
Yeah, so it's kind of how I mentioned we think about portfolio construction. We're looking at risk from a portfolio angle, an asset angle, region, sector, ESG, and then down to the stock.
So is it versus the econometric results? So that kind of gives a playbook, and then you're comparing it to that result? Or what is it that you're doing to say something has risk or doesn't have risk, and you have to act on it, either whether from a positive perspective or a reduction perspective?
Well, I guess everything has risk, right? So it's just it's a question of how much you want to pay for how much you want to be paid for taking that risk.
And so how do you figure that out? Like, what is it that you're looking at?
So we're really trying to figure out, so we're looking at valuations for sure, how much different sectors, regions, asset classes have moved in the near term. And, is there any kind of opportunities, any kind of dislocations that we can take advantage of? But we're not churning portfolios, as I mentioned earlier. Like, we're adding a few names a year. So we're not like actively
being tactical
changing. Yeah, we're not.
Yeah. And so, I mean, to be fair, like 30 names in then ACWI is a very concentrated portfolio, right?
Yeah.
So so that's certainly,
we've got conviction.
Yeah, you have to have conviction with that.
Yeah.
And so, type of investors are aligned with that type of concentration? Who is it that seeks you out?
So typically people seek us out because we're known for the work that we do on the impact side. So in shareholder advocacy, we do have clients that are just interested in performance and not excited about ESG at all. But for the vast majority, that's why they find us. And the majority of our clients we have a lot of family offices. That's probably about half of our clients. And the other half are foundations, endowments, faith-based institutions, and platforms. So they've already self-selected to be, all in to ESG.
Okay. And what type of communication do you do to them? Are you talking about the initiatives you're taking, or the type of work you do to due diligence? Maybe help us understand a little bit about how someone, known in this space does communicate what they're doing to their investor base.
Yeah, so we put out a fair bit of materials. Most of them are on our website, but sometimes we do kind of client communication only, like we just did yesterday with the what's happening in the financial sector. But we'll write on investment themes where we think we have something additive to say. And then, once a quarter, we also put out an impact update to kind of discuss what we've been doing with our corporate holdings and how we've been pressing them for change. We also do some public policy work, so we talk about that. And then every 2 years, we issue a nice big fat impact report. And we do it every 2 years because we think, over a shorter period of time, you're not really getting the full scope of what's happening, because true impact takes change. It takes longer than 2 years typically, but you can kind of look at a trend that way. And then we also publish reports more frequently, typically once a quarter, on some kind of social or environmental theme. And we do also send out emails about stocks that we hold, typically a new portfolio holding. We'll talk about why we like it from a fundamental perspective. And then, here's what we think about it from a thematic or ESG perspective. And here's what we're thinking about how the company can improve and how we're going to help them get there.
And are you, taking board seats or just, writing letters? Is it proxies? What is it you're doing to help a company get better?
Yeah, so we manage $700 million. So we're a pretty small investor in the scheme of things, but we get really large companies to change the way that they do business. And that's, I think, really impressive given our size. So I don't remember if it was last year or the year before, we got Apple to change their executive compensation plan to include a focus on sustainability factors. That wasn't there before. So now Tim Cook and other executives have the cash or part of the cash portion of their bonus tied to sustainability and especially DEI factors. So even though we filed a shareholder proposal for 2 years, they got a pretty low vote, and and then the company reached out to us and said, we think you have something here. We'd like to talk to you about it. So that took about 6 months of dialogue. And then they announced that that's what they were going to do. We had the same result with Google, with Alphabet. They've also changed their exec plan, although not as strongly as Apple has. So we file shareholder proposals. Sometimes we get a majority vote. Sometimes we don't, but it's all pushing a company and its board to really understand the risks and opportunities from the factors that we've identified.
That's great. And so hopefully people here can find some of those online to kind of look a little bit about the type of work that you're doing. Do you also showcase that on your website, or would they be looking for filings?
You can absolutely look for filings, but it's all on our website and our impact report. We do it. The last bit of our impact report is a detailed table of here are all the companies that we're engaging with. Here's why it's important. Here's how far we are so far.
That's fantastic. And, looking back, you've obviously had a long career in this. Sonia, what's one of the greatest lessons that you've learned in your career that might be helpful to someone, either, experienced like you or starting out, to be thinking about that maybe it'll resonate over time?
I think just doing, the advice that I had was, do what you're interested in. And I was really interested in ESG, when I was a portfolio manager, but back in the early 2000s, there wasn't a lot of appetite for that kind of work. And I really didn't know how to talk about it or how to research it, but I really kind of went with that. And I actually wrote a blog post last year about it because, if you're passionate about something, you can figure it out, and often you'll be ahead of the curve. And so that's what I felt I've done in my career.
Yeah, I used to do what used to be called governance investing way back in the day. And there wasn't a lot of that. It's different from what you see today. It was, a little bit more behind the scenes and working with them and improving them. So when I was looking at, back then, ESG was barely even a topic.
Right.
Obviously now it's a hot topic, but looking through who's really doing it, who's making change, how do they review themselves? I think call it the devil's in the details on that. So I love to talk to people like you who are day in, day out doing it. And obviously you're holding yourself accountable. You're speaking to your clients about it, which I think is critical versus checking a box. So thank you so much for giving us some insights here into what you do. The last question for you, Sonia, is how can folks best find you, either to keep abreast of what you and your firm are doing or to get in touch?
Absolutely. So we have a website, zevin.com. People are welcome to follow us on LinkedIn or Twitter. We're pretty active on social media. And feel free to link in with me as well.
Fantastic. Thank you so much for sharing your ideas and your thoughts and insights with us today.
Thanks for your interest, Nadine.